If the UK or Europe was to be given the opportunity to grow by 2.4%, I think that's what the GDP expectation for Q1 in the US is, I think they would bite your hand off. I think that's exceptional. It's US exceptionalism at its finest. And I don't expect that to change in the short term. I can see a lot of momentum. And what we need to remember is not only monetary policy that acts with a lag, it's also fiscal policy. And there's been a huge fiscal impulse coming out of COVID. And I think that's going to continue strengthening the US economy. But if we do see this higher for longer environment for interest rates, that will eventually feed through to the real economy and slow the US down. I think in the UK and Europe, where the pass-through effect of higher interest rates leading to an economic slowdown, it's narrower, it's shorter because of the mortgage market, because of the nature of the terming out of debt in the bond market in the US relative to the UK and Europe. So higher for longer is going to impact the UK and Europe faster, leading to a more challenging economic environment than the US, which probably has a little more resilience in it still.
So you have a firm belief, or perhaps in your notes you speak about how the risk of a hard landing persists amid rising market complacency. So why is this time not different? Why is this time not, there are even conversations about no landing, not just a soft landing for that matter, and yet you reckon a hard landing even persists still.
And I think this time a year ago, the market expectation was that we were going into recession. That made us a bit uneasy because it was so consensual. Now, most people have thrown in the towel, they've abandoned that idea. That puts complacency into the market. There's a lot of euphoria if you look at credit markets where spreads are.
You can't blame them, right? I mean, you speak about that data, sure. On the economic side, you have all this blisteringly great data as well that points out.
I can blame them and I will blame them. I think there's a huge amount of complacency. It's euphoric and that adds to the risk. If we do get this higher for longer rate environment, which we expect, the market is expecting 2 rate cuts this year. We have to remember we're coming up to the May meeting now, where the markets are expecting no cuts. So they're now expecting cuts to happen in September. But the last time in an election year, the US cut rate further out than May was in 2008, going back to 1992. It was only 2008 when the world was falling apart. So you can argue why that happens, why the Fed is a bit worried about its view on how it's going to impact the US election. But the likelihood is we may even see less cuts than 2. So I think that adds the risk that the longer we keep here with rates, the more concerning I'm going to be about the UK economy, the US economy, the European economy. And I think it's time to buy government bonds. This is a really attractive entry point at 2% real yields. I would be slightly concerned about the economic picture, slightly concerned about risk assets. At these valuations, which are simply not pricing in this hard landing scenario, which hasn't gone away. It may be different this time, but we should be very cautious about using that phrase.
It feels like